You've probably heard about the Analyst Academy from Fundamental Edge by now. So instead of repeating the basics, let's talk a minute about what the Academy is and is not. The Analyst Academy is a practical course on the tools and skill sets required to succeed in the buy-side analyst seat. The instructors have experience from firms such as Maverick Capital, D. Shaw, and Citadel. But what is the Academy not? It is not a course on stock picking. It is a rigorous guide to learning and process. It is not a guide to pod shop investing. The Academy attracts a wide range of equity investors, from multi-managers to long-only to family offices. Rather than teaching a particular style, Fundamental Edge equips learners with the essential skills required to hit the ground running and support their PM. It is not a financial modeling course. Modeling is, of course, part of the curriculum and plays a central role, but the Academy is more than that. It teaches idea generation, thesis communication, and how to add value as an analyst. To learn more and access a 10% discount code, go to fundamentaledge.com/YAVP, or just see the link in the show notes.
All right, hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this pod, it'd mean a lot if you could rate, subscribe, listen to it wherever you're watching or listening to it. With me today, I'm happy to have on, I thought it was the third time, but I looked it up. It is for the fourth time, my friend. Fifth time you get the SNL style jackets for the fifth time club. My friend, Yaron Naymark. Yaron, how's it going?
I'm good. How are you?
Doing great. Really excited to have you on. Before we jump into it, I'll just do a quick disclaimer. Nothing on this podcast is investing advice. That's always true, but we are talking about an international stock, even if 50% of their revenue is in the US and they're always talking about relisting to the US. But, an international stock carries a little bit of extra risk. So please do your own work, consult a financial advisor, all of that. Yaron, I can't believe it, but it's been almost 15 months since we did our pitch on IWG, and you reached out to me and said, hey, there's a lot going on. The thesis continues to play out and wanted to do an update pod on that. Obviously, I love having you on, so wanted to do it. So we are talking at the beginning of June 2024. Why don't we just people can go listen to the first podcast for a really comprehensive overview of the overall thesis, but why don't we do a quick, here's the IWG pitch, and then we can hop into the updates and everything.
Yeah. So IWG is the largest co-working flex office company in the world. They have about 3,500 locations today. They've been around since the 80s. They were founded by the current CEO, Mark Dixon, back then. He still owns about 25% of the company today. And it's been a very incredible kind of owner-operator, self-funded growth story with good unit economics. They've basically self-funded the growth from the first location, which Mark opened with, $100,000 of his own money or something like that. And, they've used the cash flow from that first location to open more locations and all the cash flow from additional locations to continue investing and growing the network. And that's how he's been able to retain, such a large ownership stake in the company while also, having a lot of other expensive hobbies on the side. And, they've grown responsibly, unlike, WeWork, which burned $20-something billion to, open hundreds of locations. IWG was able to generate cash, buy back stock, pay out dividends, and get to 3,500 locations. So they've done it in a responsible, capital efficient way. A few years ago, coming out of the pandemic, they really started transforming the business away from, their traditional owned and operated locations where they sign leases, put up the capital, and then sublease the space to individual tenants towards their managed and franchise business where they allow other people to either sign a franchise agreement with the company and pay the company a royalty to use their brand and, IP, or management agreements where IWG will come and actually run a co-working space for the building owner and take a management fee for those services. That part of the business was a few hundred locations coming into 2022. It'll probably break 1,000 locations this year, and they are probably going to start adding 1,000 or so a year for the foreseeable future. So the entire network today is 3,500 locations. They signed in 2022, they signed 400 management agreements. In 2023, they signed about 800 kind of capital-like management agreements. This year, I expect them to sign 1,000 plus, and that's on an entire network of, again, 3,500 units and a managed and franchise network in the hundreds. So we're pretty quickly approaching a place where they will be opening a significant amount of new locations every year. Those new locations will drive management fees significantly higher. The managed and franchise business probably lost 20 million pounds last year in EBITDA. It's going to be about break even this year in terms of EBITDA. I think it'll probably generate, 25 million pounds or something like that of EBITDA next year. And, looking a few years out, it will be in the hundreds of millions. So, relative to the current size of the business did about 400 million pounds of EBITDA last year. And that's with negative contribution for managed and franchised. That business will start to contribute several $100 million of EBITDA looking out a few years, which is significant growth. That growth will come without CapEx. It's a much more stable profit stream than their legacy business. Less operating leverage, is worthy of a much higher multiple. And I think we have a big, opportunity to both get free cash flow growth and multiple expansion, which is obviously,
that's the dream.
Yeah, it's the dream. It's the dream. So I think, we're on the cusp of the inflection. Stock has basically done nothing since, we spoke 15 months ago. Stock has basically done nothing since 2013. Actually, since then, revenue's grown a lot, the network's grown a lot, EBITDA's grown a lot, but the valuation has compressed a lot. And for a variety of reasons that we, discussed in the last podcast, happy to go through them again. But I really feel like we're on the cusp of a big inflection here. And figured it was worth catching up. For what it's worth, I reached out to you before Mark Dixon had a big stock sale last week, and that was an additional kind of wrench that was thrown in that I'm sure we'll talk about. But I still feel very strongly that the thesis is intact. So figured I would get on here and kind of talk through it with you.
I think I'm remembering from the first pod we ever did, way back in the depths of COVID days. I said, Yaron, how you're a good guest? Because every time I'm about to ask a question, you answer it before you do. And that still applies today, if I'm remembering correctly, because the first question I want to start about, it was last week, I think, maybe 2 weeks ago. I can't remember what is time these days. But Mark Dixon, the CEO, he sells a block of shares on the open market, and the stock draws down, about 10%, probably down about 5% as you and I are speaking. And Mark is to me, having followed this company for a while, kind of the biggest question mark. Because on the one hand, I really like him. Owner operator grew this thing. I remember during 2016 when he was telling everyone, guys, WeWork's going to explode. Like what they're doing today is what we did during the .com bubble. We blew up. They have learned none of our lessons. I guarantee you they're going to explode. I like Mark. He's a straight shooter. He's built this business. On the other hand, there's just some quirks about him that have given me some unease. And one of them is, you see this inflection. A lot of our friends are invested in IWG. I see this inflection. He's talking about, hey, I've got quotes from him. We've got a huge runway. We're generating more and more cash as we grow, all this sort of stuff. And then he sells a block right before the inflection. So I did just want to ask you about the Dixon sale and everything, because it kind of diverges both owner operator and this big inflection that's coming.
Yeah, I mean, to put in perspective, he owned 280 some odd million shares before that sale. He sold 35 million shares. So he still owns 250 million shares. There's $1 billion outstanding. So he still owns 25% of the company. He, over the last, few years, he's put in 100 million plus pounds of his own capital into the business. Most of that came in during the pandemic. There was an equity issuance that he subscribed for more than his pro rata share on. He put in 90 million pounds then. He's also bought stock in the open market.
Well, do you remember what the equity issuance was at? Was it at 200? I can't remember.
It was in maybe 225 or something like that. Yeah,
so he's kind of selling this right now at slightly below break even.
He sold at 195 and he bought in at 225. He bought stock aggressively in 2018, 2019, 2020, very aggressively with that 90 million pound buy, 2021 and 2022. I think he really believed the stock was on the cusp of working. If he was wrong then about it being on the cusp of working, maybe he's wrong now about it being on the cusp. So I see how there could be some doubt in his mind of the stock really should work here, but I really thought it should work in 2018. I really thought it should work in 2019. I really thought it should work coming out of 2020 and 2021 and 2022. So I really think it's going to work now, but who knows? And I'm tired of living like a poor man when I'm really rich, because he's the CEO of IWG. He makes a few million pounds a year, like low single digit million pounds. that doesn't fund the lifestyle of a billionaire, right? If you like $2 million, £2 million a year does not fund the lifestyle, especially a billionaire like him who has nice hobbies. And so,
Do you see this little small violin that I'm playing for him right now?
How he used to fund a lot of his hobbies, I believe he has had some stock sales, over time. But really he was getting dividend income, right? This used to be a dividend payer coming up to the pandemic, at which point they turned off the dividend. And so the dividend went away. He still continued making his, small salary for a billionaire. And not only did he stop getting the dividends, he actually put in 90 million pounds and bought back stock, besides that. So he put in 100 million pounds of his own liquidity into the stock at a time where his dividend got shut off. And, all his outside interests didn't really go away. And I think he thought, okay, I'll tighten the purse strings personally for a little while until the stock triples, and then I'll sell down my stake and it'll be fine. But after some period of time, this is just my read. Like, he hasn't told me this, but my read is he's probably like, okay, I'm done being patient. How much longer do I need to keep waiting to live like a poor man when I'm a rich man? And like, why should I, keep living the way I don't want to live? Like, the whole point of being wealthy is to be able to live the way you want. And so, like, all right, fine, I'll sell 35 million shares. I'll get my 90 million pounds back, or whatever. I guess, $90 million or whatever it was. I'll be able to live, fund my outside interests. I'll still own 25% of the company. If the stock goes up 5x from here, I'll still be very happy and a very rich man. And it is what it is. I think I don't read too much into it. He still owns a lot of stock. I don't think, it calls into question anything he's said about the business over the last few years.
If I could just ask you, Andy, one thing that does jump out to me, having covered the company for a while, I think it was back in 2018, Brookfield, if I remember correctly, got very close to buying IWG. And then the deal kind of fell through, and IWG, instead, as you're saying, Mark Dixon bought stock and the company bought pretty aggressively on the open market, right? So if you think back to then, he almost had an exit, and instead he said, I see a lot of value here. And then COVID kind of changed everything. And then, he put, as you said, he put money in, he's bought stock. That's 6 years of delayed gratification on a thing. And yeah, they've got the inflection coming. Like, it is weird to sell now, but he's been waiting a long time, and he's still very, very exposed to an inflection. Let's talk about that inflection. A big part of the thesis. I mean, look, I think a lot of IWG's business is interesting, but the real thesis here, I think the really sexy thing that's flipped you onto this is the manage and franchise room. So I just, when we talked 15 months ago, the manage and franchise, it was a little more nascent. They were talking about huge growth. You mentioned a little bit up front, but I just want to dive into, we're 15 months post that first podcast. How is this performing, and how is the ramp up of these managed and franchise units going?
Yeah. So, when you speak to management, they say, look, 2022 is the year of signings kind of accelerating. 2023 was like a real big signing year, 800 locations. So that was kind of the signing period. 2024 is the opening period where we're going to see openings really accelerate. And I think, if you look in 2022, there were like under 500 total managed and franchise locations in the network. This year, I think that'll more than double, between 2 and 3x. So I think we'll probably end with, close to 1,200 locations on the managed and franchise side. But those all won't contribute meaningful management fees yet, because you need to ramp those locations. So you basically have signings, then openings, then the revenue impact and financial impact. And so I really think 2025, we will see the big inflection on revenue and EBITDA, and that inflection will continue to accelerate. So it was like 30 million pounds. I'm talking in pounds because up until the end of 2023, this was a GB, a sterling reporting company. In 2024, everything's going to change to dollars. But in my head, I'm my model and everything, I still think in pounds until this, next year, I'll update my model. But 30 million pounds a year of fees. That includes royalties from the franchise side, and management fees from the managed side, and signing fees for when new agreements are signed. There's an upfront payment kind of paid upon signing. It was about 30 million pounds a year. I think this year it's going to be like 50 million pounds or something like that. Or sorry, it was 30 million pounds, I think, in 2022. In 2023, I think it was like 50. This year, I think it'll probably be 75. And then I think it's going to start growing significantly in the coming years as these locations open and ramp. EBITDA was a $20 million EBITDA loss last year. They say it'll be around break even, slightly profitable this year. So we're going to see an incremental 20 million pounds of EBITDA between last year and this year, managed and franchised. I think that 20 will add, we'll probably grow EBITDA by 30 or 40 million next year as revenue inflects. And then we're going to start jumping substantially from there. So we're going to start seeing the operating leverage here. I think, we're a couple years away from seeing hundreds of millions of dollars of revenue and EBITDA from this segment. I think we're going to see the big inflection, back half of this year and into 2025, which is why I think it's so exciting. I think up until now, people have doubted that, what they're saying about these signings is true. And I think we're starting to see it reflected in revenue, and, EBITDA will follow as well.
And just to add on to what you said, they've said, hey, from signing to open takes 10 months, and then from open to full ramp takes 17 months. So, even though we're 15 months away from our last podcast, and that feels like forever to you and me, it feels like forever to anyone listening. Like, if you think about that, if they signed 800 units last year, right? So they've signed 1,000 units plus since we talked. None of those 1,000 units are really delivering anything for the company in the trailing financials, which is just kind of crazy to think about.
Correct. I think, 40 million of EBITDA next year, probably 100 million of EBITDA in 2026. And that's from negative 20 in 2023. That 100 million of EBITDA in 2026 will still have meaningful growth in 2027, 2028, 2029. And it's not crazy to think that 100 million pounds of EBITDA is worth the current enterprise value right today. And it has meaningful growth ahead of it. Plus you have the owned and operated locations. Plus you have Worka. I think when we spoke last time, I laid out a path to free cash flow, growing a few multiples from where it was back then. I still think that's very realistic and reasonable. I don't think it's crazy to think we're going to have high hundreds of millions of pounds of annual free cash flow looking out to the end of the decade on an annual basis. And I think the multiple has room to run significantly as well. And that's how multi-baggers are made, when you get massive free cash flow growth and multiple expansion. So I continue to think the thesis is intact, on that basis. And I think we're, a year and a half closer to actually realizing that in the income statement.
Brett Coffrin, founder and lead trainer of Fundamental Edge, barely remembers his first year as a hedge fund analyst. Most of that year was spent in a blind panic. Was his research any good? Was he learning fast enough? What did his PM really want from him? Trading on the buy side was non-existent 15 years ago when Brett was a new analyst at Maverick. Then he actually got demoted. Then he worked harder, found mentors, and asked for uncomfortable feedback. Eventually, he turned it around, learning by osmosis from the talented people around him, and rose to managing director. But is this the best way to develop talent? Brett doesn't think so, and that's why he founded Fundamental Edge. The Fundamental Edge Analyst Academy provides students with the tools, frameworks, and confidence to excel in any fundamental equity analyst seat in the industry. Lose the panic and fast-track your career on the buy side. Find out more info about their next cohort at fundamentedge.com/YAFP, or just see a link in the show notes.
The company had an investor day back in December 2023. I don't believe there are transcripts of the investor day anywhere, which is kind of frustrating, but I listened to it at the time. I know you listened to it. I think it's worth us. They laid out a lot of the thesis that if you had listened to our podcast, you would have heard. But I do think it's worth touching on the December investor day and just talking about any takeaways or anything you learned there.
Yeah, I was able to go in person. It was great. I mean, they had a lot of the senior leadership team there. They all stuck around after the investor day, and I got to spend time with basically each of them. I stayed around for probably an hour or two after the investor day ended, and just got to know them a little bit better. I think the biggest
this personal guy, networking, doing everything.
It's a big position for me, so I spent a lot of time doing maintenance work, not just talking to the company, but talking to building owners, talking to other industry professionals, whether it's people at big brokerages, and then talking to people at competitors. So that was definitely a helpful day. The biggest takeaway was they guided to $1 billion of EBITDA. It's about 800 million pounds, up from 400 million last year. They said that was over the midterm. I think, if you kind of push them on when the midterm looks like, it sounds like it's probably 2028-ish. So from 2023, which was 400 million pounds of EBITDA, to 2028, that's 5-ish years. They think EBITDA doubles. That $1 billion of EBITDA. I asked Mark what he thinks the free cash flow conversion looks like on that, and he was like, I don't know, 70% plus. So $700 million of free cash flow. I think the multiple at that point will be significantly higher because a lot of that free cash flow will be coming from much higher quality revenue and earning streams. I don't think it's crazy to think it's 15 times. I don't think it's crazy to see it at 20 times free cash flow. If you tell me it's 12 times free cash flow, I don't think that's crazy either. But I think it's 15 times is kind of a decent bogey, that puts us at right around $10 billion versus I think it's probably $2 billion today. So that's five bagger. I think it could probably do better than that on all fronts. So I think and they will say there's a fair bit of conservatism they feel like in their model. So I think the numbers could end up being higher than that, and the multiple could end up being higher than that as well.
And I would just say, I can't remember if it was the Q4, I think it was the Q1 call. They've been reiterating that 1 billion number. So let me pause here. I've got a few more questions I want to ask, but you see the inflection happening. I think I see it. A lot of our very smart friends see it. Like, people can go on Seeking Alpha or wherever and look at fund letters, and there are some very smart funds that are in IWG. And many of them say, hey, shout out to Yaron for giving me the idea. The stock is flat over the past 18 months. I do know people who look at it and like kind of vomit in their mouth a little bit. So what is the bear case? What are people who look at this company and pass, or what are people, why is it flat over the past year? Why is the market not seeing what so many value investors seem to be seeing here?
Yeah. I mean, there's so many bear cases that you hear and that I think sound good at kind of first blush, that when you peel back the onion could be disproven. I think the biggest one when I first started buying my shares was that this management franchise isn't real. And Mark has always kind of overpromised, underdelivered. And this is just another overpromise that he's...
I 100%. When they first came out with this, every person I talked to be like, this is Mark, man. Come on. How many times has he told you we've got this big... You're like, come on. Nobody's going to have managed.
In defense of Mark, he has been a visionary. He's, very much delivered against his vision of a much larger business, more profitable, self-funded, efficiently capitalized. And, he's definitely had some big, ambitious, long-term goals that, may have seemed unrealistic at the time. And maybe he's just, sometimes to build a market, you have to talk about a market, right, that doesn't exist today, and kind of be ambitious and set ambitious targets and goals. And, investors should understand that when a CEO or a founder speaks about these big, ambitious goals, that they don't mean near term. I think, and he did have, some kind of midterm targets of moving the business towards, capital light more quickly by selling down owned locations. Yep. And that, I think he was on the path to doing that, but the pandemic and WeWork's troubles kind of threw that off. And that, yep. I don't think that was not his fault. WeWork also destroyed the integrity of big city markets around the world, whether it was London, Chicago, New York City, and that was not his fault. They also had free money to compete. So not only destroyed the pricing integrity, but they became a comp where it was just a distraction. So there were lots of things that I think investors kind of blamed him for that I don't think were necessarily his fault. But I definitely thought that was, something to look into and better understand, that he has this reputation of overpromising, under-delivering. So on this managed side, I really wanted to try to independently confirm that what he was saying was true. And the nice thing about this business and this end market is there's lots of people willing to talk to you, building owners, whether they own 3 buildings or whether it's a real estate private equity firm that owns 50 buildings, people at the brokerages, whether it's CBRE or the other brokerages, people at competitors. Everyone just, it's real estate. Everyone loves to talk and give their opinion, and you could, reach out to people on LinkedIn, which I've done. I've spoken to dozens and dozens of building owners. I've conducted surveys of building owners as well, just more methodical surveys, where I've gotten responses, I've gotten feedback, and I've been able to independently confirm and verify everything Mark has said about this managed business in terms of unit economics, in terms of pricing structure, in terms of just anything he said. I've been able to independently confirm, and I feel comfortable with it. Then there's kind of the macro type. This is commercial real estate, it's office, it's levered, it's cyclical, it's UK listed. All of those I think are silly. I'm happy to address any of them that you think are kind of holding people back from buying the stock, but I don't think those are real. If you believe this management thing, the unit economics are real, and what Mark says is real, that should overwhelm any macro or office related headwinds that people are concerned about. But if you think that's not the case, I'm happy to address them. The most important thing that I've spent a lot of time trying to understand, that I think if you're really kind of intellectually honest as an investor, that should worry you, is when a company is growing this quickly, there's a risk that they grow too fast. They have all these new building owner partners that they're managing real estate for now. And, in order to get those signings, there's a tension where you want to overpromise up front. So they give you their building to manage. But then you run the risk of disappointing them down the line because you overpromised. Then they're unhappy. And if they're unhappy, this is an industry where everyone talks to everyone. They'll tell the next 10 building owners that they know that this sucks, not to sign any management agreements with IWG. They won't give them any more of their buildings because they own 10 and they only gave them 1 so far. And so if that were to happen, where they bid off more than they could chew, they have a bunch of frustrated building owner partners, I think, no investors would put a multiple on the management fee because they would assume it's just going away. They would DCF it, but not put it wouldn't be a very durable cash flow stream. I think personally, that's the biggest bear case for true long-term investors, not trader type investors. I've gotten comfortable that so far to date, that has not been happening. I've like I said, I've spoken to dozens of building owners myself on the phone. I've reached out to on LinkedIn. I've conducted surveys. The last survey I conducted, it was, just under 50 building owners that have had at least one managed partnership location open with IWG for at least 6 months or more. So they're not newly signed and just open, but at least 6 months having been opened. And only 7% of them were, we asked them to rate on a scale from 1 to 5 how satisfied they were, where 1 was least satisfied and 5 was very satisfied. And we got 7% were 2s, which was unsatisfied. A vast majority were 4s or 5s with a big kind of fat 3 in the middle. And so, it was like 70 something percent were 4s and 5s. 7% were 2s, which was dissatisfied. And then you had the remaining at 3s. So they're generally happy. They generally think that IWG has delivered more revenue than they projected for them when they took on the managed partnership agreement. They generally all say they're going to sign more managed partnership agreements with IWG. And by the way, I focused heavily on the US and North America because that's their biggest market. There is some, Europe and Canada and stuff like that, but vast majority was the US. I think, their existing building owners are going to sign more of these locations. They're happy with the way the partnership is going. And that, I think, is the most important thing. So as the numbers start to show up on the income statement, and as people get more comfortable that that's true, I think the stock will work.
Did you ask in the survey you did how many, if they plan on opening more buildings with IWG?
I did ask. They said yes. I didn't say how many more because
That's awesome. No, that's really, look, it's sometimes funny. This will blend into the next question. Sometimes you'll do a lot of work and you'll talk to the management team and then, put a podcast up or talk to another investor and they'll be like, oh, this bear case, obviously this is going to happen. And you'd be like, well, I've talked to the management team, I've talked to the building owners and all of them are saying something different. I understand your opinion, but when you talk to, 100 people on the ground who are all saying, yes, this is really working for us, that's different. Two questions on this. First, I'm with you. One of the tough things with a franchise business is because the franchise revenue is so high margin, when you're investing into a franchise business, it can look great until the day it implodes, right? Because it's always going to be very high margin until it's the franchisees' health that really matters. And you might look great while your franchisees are struggling, and then they all pull the plug, right? If that was going to happen here, we mentioned, what was it? It was 400 stores in 2022, 823, over 1,000 hopefully this year. If that was going to happen here, would it have already happened? If the managed business just didn't, or would it be more like a 26, 27 thing?
Yeah. If landlords were to be unhappy, I think it would be, 6 months, 12 months post opening, because expectations are very low for the first few months of opening. No one really expects to open at full capacity, utilization, occupancy.
Can I push back on that just slightly? I do hear you. Like they wouldn't have pulled the plug yet, but if they were unhappy or having initial worries about it, wouldn't you not see this 1,000 building growth rate? Because as you said, real estate talks. So if they were a little concerned about it, they wouldn't open their second or third managed unit, or they would have, I own the building, you own the building next door. I'd say, hey, this IWG thing, I'm a little concerned about the initial results. Maybe don't sign that contract with them. Wouldn't the growth have slowed?
It's such a big market, right? We're talking think about how many small buildings there are in this country and in the world. Vacancies in Q1 of 2024 reached an all-time high in the US. They're 20% in the office market. That's an all-time high. There are so many desperate office building owners that have empty space that don't know what to do with them. I think you could probably still sign, right? You could always find a schmuck to sign a bad deal, like in a big desperate market. And so I'm not sure it would reflect yet in signings. I think it's a harder thing to assess, which is why, I think for the true intellectual kind of business analyst, that's the one that is probably scariest. It should be the scariest. It's like, what if all our landlords will be unhappy? And I just don't think that's accurate. I think the fees will come through. I think the free cash flow will come through, and I think signings will continue. Now, eventually the signings would fall off, but I still think the market's big enough where you could, if you're over promising so many people in such a small market and so many are desperate, I still think you can get signings. But look, these people who are signing these deals, it's not like it's like a free call option for them. They're putting capital into these buildings, right? One of the questions I asked the building owners was, if you were to sign a traditional lease with a 10-year tenant or something like that, how much TI allowance, like tenant improvement allowance, would you have to provide to them? And most of them said $0 to $5 a square foot. So if someone's signing a 10-year lease, you give them $3-4 a square foot to help renovate that space. You subsidize that for them, and then you give them some free rent on top. Under this managed partnership agreement, most of them are putting $50, $60, $70 a square foot into these locations. They're paying that. IWG is not paying that. They're putting a bit. So going back to maybe a little bit closer to your point of you would see signings slow if people were doubting it. I still think you could find desperate people to sign these agreements, but this is not like a free call option. This is a very expensive way to try to generate revenue and occupancy in your space. And so the fact that people are, and by the way, they're signing, I think they pay $25,000 up front to IWG to sign these agreements. So they're paying $25,000 plus the average location, I think is 12,000, 13,000 square feet times $50, $60, $70 a square foot. I mean, this is $1 million for the average building owner. This is $1 million expenditure. And these aren't massive, these aren't Brookfields. These aren't Blackstones. $1 million is a lot of money for these guys. So they're making a real investment into the IWG brand network. This is a real partnership. So,
one other, you've talked to a lot of building owners, a lot of people in the space. You've talked about a few, but what do you think when you talk to maybe a slightly informed analyst who's looked at IWG, who's looked at WeWork, but who hasn't talked to all of these building owners that you have? What do you think the main kind of discrepancy between what you're hearing from the building owners, or what you think about how they're thinking about the partnerships versus maybe the analyst who looks at this with a skeptical eye?
Yeah, I mean, look, there's some who are just I genuinely believe, look at the stock chart and see that it's got nowhere for 9 years, and they're like, this is a trading sardine. This isn't a company that's created enduring long-term value. And there's, I think we talked about this in our last podcast where, there's lots of companies that have to grow into their valuation over 10 or 15 years, even though they're great companies that continue to grow per share value over time, but just need to derate because the multiple got too high. I genuinely believe that's the case here. Not only did the multiple get too high, the operating environment outside of the company's control got very challenging for a variety of reasons. The pandemic was one, WeWork was another, Brexit was another. And so I think that's kind of the simple one that's very easy to push back on. The other one is, look, I've been to their locations. They're old. They're tired. I read the customer reviews. the customer reviews suck, the end users, not the building owners.
I sent you. I have a IWG space right now. I sent you my review of the management and everything a few weeks ago.
Yeah, I actually, sometimes I send kind of not anonymous feedback that I get from other people to management. I'm just like, hey, here's what people are saying. Or I got feedback from the building owners, and a bunch of the building owners said they would love to have more real-time visibility into how their location's doing from an occupancy and pricing standpoint. Like, they can't just log in and see, like, here's what my location is generating in terms of revenue. Like, they have to wait till month-end reports, and they're like, why is that? So I've sent that kind of feedback to them. I need to compile yours and send it to them as well. In terms of, the quality of the locations, I think this was a for-profit business that made locations as nice as they needed to be to fill them. That's kind of what a business that's trying to generate cash and profits could and should be doing over time. Obviously, they don't want to sacrifice on the quality of the experience for the end customer, but like, clearly they've been able to fill all their locations over time.
Do you think WeWork had an impact on that? And this is N of one, right? But I was at WeWork
they were able to spend $20 billion plus making way nicer locations, way more CapEx per square foot, way nicer buildings, right? So higher rent per square foot, more upfront capital in terms of build out costs. So it's better locations, nicer overall building, nicer space within the building. And they didn't need to charge for all that premiumization because they had free money to burn. So that impacted the big cities for sure. The other thing I'll tell people is, like, we'll get to the customer satisfaction part in a second, but just on the quality of the locations, I personally still think there's too much variability. I think you could walk into one region. Spaces and HQ and Signature are kind of newer brands in general. Regis is kind of the oldest one within the network, but that happens to be 70% of the footprint. I think you could walk into one Regis and be like, oh, this is nice. And you walk into another Regis and you're like, this looks like my middle school from, the 80s or 90s that hasn't been refreshed in a really long time. And I think that will naturally become, way less of an issue as the network grows, right? The network is 3,500 locations today. It's going to double and triple in size with all these new locations, where the average age of the location is coming down meaningfully. It'll just make it easier to kind of have them all. The average age of a location will come down, but also to refresh the old ones you'll have more cash flow to do that. And I think it'll just be easier to do it all. So I do think the quality of the network will go up significantly over the next few years as all these new locations open up. In terms of, the reviews from end customers, look, you have millions and millions of users of this space. Like, if you're happy with the space, you're not going to go on Reddit and write like, I just went into Regis, it was amazing. And if you're upset, you're going to go and be like, I had a bad experience for the following reason. And so, like, I still think it's a small percentage of customers that walk in and are like, I'm never going to Regis again. They happen to be loud. I don't think that's indicative of the company's ability to fill this space, because they've been able to fill the space. They've opened tons of new locations over time. They've been able to fill them. All these new locations they've opened in the last year or 2 years, they're filling them. And so I don't think that's realistic that they're not, that something's changing, especially with all these new locations that are nicer and brand new. Like, they're going to be able to fill them.
We are talking June 4th. WeWork emerged from bankruptcy. We've mentioned WeWork a few times. WeWork emerged from bankruptcy last week. I think it was May 30th. So I do just want to ask, WeWork has been, I think they lasted longer as kind of a irrational pricing competitor than anyone thought, because they kind of got a SPAC boom cash infusion, and SoftBank was probably crazy, but they lasted longer. They've emerged. If there's a big FT piece focusing on WeWork, talking about rational price and everything. But I do just want to ask, with WeWork having emerged, how do you think about the competitive environment today versus, let's call it, 24 months ago, and kind of evolving over the next 12 to 24 months?
I think the competitive environment will be better. I think WeWork is less distressed coming out of bankruptcy than they were going into bankruptcy. They're going to be less, prone to just discounting aggressively just to get cash in the door. And they were able to reject the worst of their leases. I think they rejected, 150 leases or something like that. They were able to renegotiate another couple hundred. And they probably just, took on the remaining leases So definitely less distressed. I still think, there's going to be competition. Like at the end of the day, office space is kind of a commodity product, right? Buyers are sophisticated. They can go shop. There's tons of available options in any local market. And I think the competitive environment will be better, but it's not like I think it's going to be a massive step change in profit, lead to a massive step change in profitability. I think marginally the big city markets will become better for IWG and for WeWork. I still don't think it's going to create this massive new competitor that's a huge risk to IWG, because WeWork, even though they've restructured their leases, they came out with a clean balance sheet, or they got rid of all their debt, they equitized it, and basically got rid of a lot of the debt. The business still isn't like, even with the restructured leases and the getting rid of the interest expense, the business is still not making money. It's crazy. Like, you look at the projections they filed with their plan, and like, in order to get to a place where I think they will be free cash flow break even after maintenance CapEx, I think you need occupancy to be like 10% above where IWG's occupancy is. And IWG's occupancy is more helped by the fact that people have moved outside of the big cities coming out of the pandemic. WeWork still has to fill these big city locations. It's very hard for me to imagine they're going to end up with 80, mid 80s occupancy while taking up price. And even if they do that, they're not going to have that much excess free cash flow that they could use to open new locations. So I think they're kind of going to stagnate, right? Maybe they make some cash, maybe they burn some cash, but even if they make some cash, it's not going to be enough to open a ton of new locations and aggressively compete with IWG. Almost all their locations are owned and operated. I think they want to go the management agreement route. They have a good brand for it, but they don't really have operating history that instills a lot of confidence in building owners, right? If you're going to go to a building owner and say, hey, let me manage your space for you, and I want a 15% management fee, they're going to be like, do you know what you're doing? Can you generate a profit for me? And I think IWG will go to that same building owner and be like, they never even generated a profit for themselves. How do you think they're going to generate a profit for you? And so I think IWG still has, a leg up on WeWork from that perspective. So I don't think WeWork is going to be able to open a lot of new corporate locations because they're not going to generate a ton of cash. I don't think they're going to be able to compete aggressively for these managed locations because they don't have a long-standing history of showing that they could profitably operate these locations. And they don't even know, most of these managed locations are coming in rural markets for IWG. WeWork doesn't even know how to operate in rural markets. They've only operated in big cities. So not only have they operated unprofitably, they've only done so in big cities. They have no idea how to do it profitably or in small cities. So I don't think the management side of the business is going to see a ton of competition. And I think the most likely outcome here is still, I was hoping IWG would find a way to make a run at WeWork in the bankruptcy process. I still think the most logical conclusion here, hopefully it happens, who knows what the odds are that it does, is that, IWG will one day own WeWork.
Why do you think, I want to go back to the manager in a second, but let's just stick on that. I thought IWG would buy WeWork in bankruptcy as well, reject all the leases, almost reject everything, take the name, because I do think the WeWork name is a lot better. Keep everything a little bit distributed, but make WeWork kind of the core. You basically pay for the name, some of the good leases, and then you've taken the competitor out and done that. I was a little surprised. Like, IWG seemed like the natural best buyer to me. I don't even think they sniffed around at buying the Holdco. I do think they took some of the leases, if I remember correctly, but they didn't really sniff around the Holdco for. Why do you think they didn't take it out?
They definitely picked off some leases, right? That WeWork rejected. They picked up as management agreements or capital light agreements, maybe variable rent. Personally, I think the bid ask was too wide. I think, my impression is that Mark is a very patient man, a very shrewd, tough negotiator. And probably was like, I don't need to pay anything. This business has never generated a profit. It never will generate a profit under someone else's ownership. And so why should I pay someone for the upside that I could bring to this business myself? And, my sense is that those who were controlling the bankruptcy estate said, you're going to be able to generate a huge profit with this, so you should pay up for some of it. And the bid ask was too wide. And so, maybe they're both trying to call each other's bluff. Maybe he's like, all right, I'll wait it out in another year or two post exit. you'll finally realize you can't do anything with this. So if I sell it, if I buy it for $1, that's $1 more than you would get otherwise. And they think, all right, if we just prove to him that we have the ability to keep kicking the can down the road forever because we're operating at free cash flow break even, and he really wants it, he'll have to pay us for some of the upside because we're not going to be forced sellers, right? We're not forced sellers. What I wish IWG would have done is hired an Evercore or someone like that, or a Houlihan, or someone that wasn't already involved in the bankruptcy, engage them in November of last year, October, December, January, and said, which bonds do we need to buy to be in the fulcrum security? And then we'll be heavily involved in the bankruptcy process and maybe get involved that way. I'm not sure if that's possible. I'm not a restructuring guy, but I wish they would have just hired like a consultant that knows what they're doing in the bankruptcy process and figured out if there's a way that they can get involved without it being like an auction. But that just,
I hear you and all that, and I really would have liked IWG to take them out. But I do think there was still, like, despite everyone having been burned with WeWork, I think there was a little bit of a speculative bid because Adam Newman was in there. He was in there till the last second trying to get them. And the Urini, is it Urini? The guy who bought them, I think he's got a very sober thought here, but he already had some equity in, and it did seem to me like a guy who's very successful and had a lot of money and was kind of looking at it and being like, I am the one. Like, did it work for them? No, but it can work for me.
Yeah. I think
it might have just been a little bit of irrational pricing, and IWG thought, hey, as you said, this is going for more than we think it's worth. We'll get it at the next one.
Yeah, look, Yardi was one of the biggest equity holder, one of the biggest owners of equity. They were also a lender, but they're also a service provider to WeWork, a technology service provider. So for him, it was, WeWork is a big customer of ours. If IWG buys them, they probably won't be a big customer of ours anymore. So we'll lose a big customer to our core business. Yep. Plus, I already have money invested in the equity and debt here. Let me just see if I could lower my average cost and do well on the other side. So it's probably a combination of both of those things. I think, the secured bond, I think, got down to what, 20s, 30 cents on the dollar. Like, you could have made a play without trying to like negotiate with another side, just by buying in the open market bonds. I'm not sure how realistic that is, but that's kind of in my
you need to buy a lot of them. Yeah, I agree. Let me move back to the management. The one thing I want to yes and when you were saying WeWork probably isn't a management, even if WeWork was going to building and saying, hey, let us manage your building, you want the WeWork brand. You don't want the Commons brand or the Regus brand. You want the WeWork. You want the Ferrari of co-working space brands. I hear that, but guess what? It takes a long time to do the sales process. You have to go, as you said, it's not just, I live in New York City, so I tend to think of, the big building with a WeWork in it and a WeWork side. That's not most of what IWG doing. They're doing the Regal and the suburban places where, there's a 3-story building and they take floors 2 and 3. And to go get those, you have to build infrastructure, and then you have to go literally building owner by building owner, shaking hands, signing those deals. IWG, they did 800 last year, I think. They're going to do 1,000 this year. They'll do 1,000 plus next year. Even if WeWork starts today, to hire the people to go shake those hands, it's going to take a long time for them to get there. And every year, IWG signed another 1,000, another 1,000. So that's just to say, even if WeWork was going to have huge success here, it's a huge market. It's going to take a lot of time. It wouldn't put a dent in IWG's growth here for 5 years or something.
Yeah,
you can add anything you want there.
I think under IWG's ownership, where they could be like, look, we know how to do this in rural markets profitably, but now we can give you the WeWork brand name too. It would massively accelerate the managed partnership growth for IWG under IWG's ownership. WeWork on a standalone basis, I don't think they have a realistic product to sell to rural building owners because they don't have a history of generating profits and they don't even know how to operate in rural markets. But they also don't have the cash, to your point, to invest in the biz dev team that's necessary to go knock on doors and pick up the phone and call building owners. I mean, IWG this year is going to be break even on their managed and franchise business on, call it, 75 million pounds of fee revenues. So call it close to $100 million US of fee income. And that's break even EBITDA for them, right? Because they have this big biz dev team. WeWork can't invest.
They mentioned in the Q4, they mentioned, hey, it's not just the biz dev. We had to build out a general overhead for a supply chain. So we're building 1,000 centers. You have to build out a huge overhead so that you can go build these centers that like get the bulk pricing and get everything that you need. And again, takes time and investment.
So where's WeWork going to come up with $100 million a year to bet on something that might not even lead to signings for them? Right? They're exiting without generating really cash. So, on the counter, under IWG's ownership, going back to like why they should own this, there should be the natural owners of WeWork, is like there's probably $400 or $500 million US a year of corporate overhead that WeWork has to have that IWG. I asked Mark a couple of years ago, before WeWork really was like on the verge of bankruptcy. I was like, hypothetically, if you were to own WeWork, how much of their corporate overhead do you think you would have to bring in on the IWG side? And he said zero. So like literally, if WeWork is generating $0 of EBITDA, which they will come out with positive EBITDA. I'm not sure if it'll be positive EBITDA less maintenance CapEx, but positive EBITDA. But let's just say it's zero of EBITDA, and you have $400 million of synergies. That's $400 million of EBITDA. Like, we should have been able to pay $1 billion for this, in my opinion. Now, maybe Mark is like, we don't have to, so I'm not going to bid it because we don't have to, because it's not worth $1 billion to anyone other than us. So why should I have to pay that? Hopefully they could narrow the bid ask and figure out a way to make a deal happen. I just think it would create so much value at IWG, even if you had to give upside warrants away. Not anywhere near today's price, but like, all right, once the stock triples from here, we'll give you an extra 10% of the company in warrants. And, we think we're going to be up 10x. So you should be happy with that, plus some cash today for a business that will generate no cash for you under your ownership.
Especially, they're a private company now, but in bankruptcy, it happens all the time where you get the, some cash plus the warrant call. That'd be a little.
Like all the best investors, Fundamental Edge believes that the learning process never truly ends. That's why the Analyst Academy is just the beginning of their journey with you. Fundamental Edge alumni gain access to exclusive content, such as the guest speaker series, which recently featured Rich Falk-Wallace of Arcana, who discussed the role of factors in fundamental investing. Alumni can also look forward to frequent webinars, case studies, and content from industry partners. Fundamental Edge recently hosted its first Analyst Spring Training Conference in Scottsdale, Arizona. Attendees enjoyed a range of speakers, judged a stock pick competition, and networked with fellow alumni. Mark your calendars for the spring of 2025 for the next conference. Visit fundamentedge.com/YAVP or just see a link in the show notes for more information about the next Academy cohort.
I said before we started taping, I was like, oh, it's just an update pod. Update pods only take 30 minutes-ish. Of course, we've been going for almost an hour. I have a soft-ish stop that's going to become harder over time. So I want to end with two questions. I have so many things in my notes that we're not going to get to, but I want to end with two questions. First question. You're a very thoughtful guy. This is a large position for you. I think you mentioned it earlier, but I just want to confirm. When your biggest worry as the story evolves, as we hit this inflection, your biggest worry, is it that the managed business all of a sudden runs into a wall where, hey, the old contracts are not ramping up and the building owners aren't happy, or is there something else that you're worried about?
Yeah, I mean, it's everything is event path driven. So in the world where management hits a wall, I still think the current business, you can get upside just from kind of the current business alone. The current business is still under earning relative to its history, right? We're at 24% EBITDA margins today on the corporate owned locations. That used to be high 20s. Worka is still growing. And there's a lot of costs you would cut out of the business if managed and franchise wasn't working, such that it wouldn't be break even at today's scale. It would generate some profits at today's scale. So if managed and franchise doesn't work, I still think profits grow. It's still very cheap, and I still think you get upside, but not 5-bagger, 10-bagger type upside. But if managed and franchise doesn't work and the core business suffers because we go into a recession and the economy is bad, that's how I think you get real downside here. So the thing that worries me is kind of both of those things pan out, right? Managed and franchise hits, peters out, doesn't work, and we hit a bad recession. And that's how I think you can get permanently impaired here. Not massively so, because the valuation is not that expensive. The balance sheet is in pretty good shape. I don't think we're going to be diluted through, expensive debt or equity issuance from here, but I could see how you lose money from here if both of those things happen.
This is famous last words, but I actually do think a recession would be interesting for them, just because I do think for all but the largest of largest companies, I think especially COVID and hybrid proved out to a lot of them how important flex can be. And I do wonder if we saw a recession, if it's re-spurred the trend to flex, if that makes sense. Both with companies saying, hey, let's do flex. So when we need to do layoffs, we can, drop our lease space by 10%. And for the building owner saying, hey, we continue to lose office contracts. Let's switch more to flex because they've got that network. They can get people in. We don't have the skill set. The network that IWG brings, the skills, that's really important to us. I wonder if on both sides a recession.
I can give you two data points that confirm that view. So one, during the pandemic, coming out of the pandemic, CBRE bought 40% of Industrious. They were surveying their big enterprise customers on the real estate needs, and those, the big enterprise type customers were saying, pre-pandemic, we don't need flex. And during the pandemic and post-pandemic, they're like, we really need hybrid flex. And they're like, okay, we need to have some offering for that. Let's buy Industrious. So they spent a lot of money buying a piece of Industrious for that reason. So that's confirmatory from them. I also spoke to someone in the industry who doesn't know exactly, but is pretty well informed on the space. And he, his best guess was that IWG has low to mid single digit percentage of its revenue coming from enterprise today, but thinks that enterprises they move more slowly on the way to flex because HR needs to get involved and CFOs need to get involved and boards need to get involved. It's the Titanic, it's not a speedboat, but they're well on the way to moving towards flex. And this person estimated that it's going to go from 5% of the revenue today to 25% of the revenue over the next 5 or 6 years for IWG. And all of that growth on the enterprise side is all going to go to IWG because the enterprises only want to deal with the big international, massive network effect footprint. They don't want to deal with lots of local, mom and pop operators and have a bunch of invoices and negotiation to do. And so, those, I do think, to your point, that could accelerate that even further. And I think we're on the way.
Last question on enterprise. I actually completely agree with you, though I did hear from a few bears who said, hey, Andrew, you and you, especially after our first podcast, because that's when we publicly put out that they were like, look, Andrew, you guys, I think enterprise makes total sense. But they were saying, do you think JP Morgan, with all their office space, all their relationships, all their brokers, do you think they couldn't get like custom flex or flex-ish type office space where and when they needed it if they wanted to? And I honestly don't know. And I don't think it makes or breaks the IWG case, though obviously if JP Morgan needs to go through IWG, that's better. I honestly don't know, but I just want to toss it over to you because as we're talking, I'm remembering I heard that from I think 3 different people who were pretty thoughtful and had thought about it. And they were like, look, the super enterprises don't need it. And I kind of thought the math and the evidence said they do, but I just want to throw that to you.
Yeah, I mean, every use case is different. If you need 1 employee or 3 employees or 5 employees in a bunch of different places, do you really want to manage a footprint of 50 different locations across the US that you have 5 employees each in? Even if you had the scale and the ability to do that, you need a team to manage those negotiations, and you need to make sure that the office space was presentable for your employees and that the lights were working. It's just, why not outsource it, right? It's not a huge premium you're paying to IWG to do it for you. And
it's kind of like saying, hey, do you think JP Morgan, do you think they need to outsource their maid service? Like they're a huge company. It's like, well, yeah, this is a small spend, and employee safety and employees being productive is actually a lot more important than maid service.
Yeah, the more dispersed enterprises are willing to have their employees, the more it caters to having someone like IWG do that for you. If you're going to have 300 employees in Denver, then you could just sign a lease in Denver and figure it out. But if you're going to have 5 in Denver and 5 here and 5 there, I just think IWG is just a much simpler, easier option for you as an enterprise. But again, it's only a single-digit percentage of their business today. I think this person has a good handle on it. I'm not sure, but that growth is optionality. I don't think it's necessary.
This is all right. This is your 4th podcast. I wore it for the podcast yesterday. So we're going to have you back on for the 5th podcast. For the 5th podcast, I'm going to pre-ship you. I'm pulling it out. I'm going to pre-ship you the Elite Yet Another Value Podcast 5-timers shirt. For the people on YouTube, I'm holding it up. And I'm pre-shipping it because I've enjoyed these so much. But you've got to promise to wear it for the 5th time. So people, SNL style, they can see you wearing the 5-timer jacket, and we'll talk about a new idea, because unfortunately for you, I read all your investor letters, so I know what you're working on, and we'll have you back on the further. But Yaron, this was great. People can reach out to Yaron on Twitter. You can find him very easily. But this was great, super thoughtful. Really appreciate you hopping on, and can't wait to have you on.
2 more quick points.
Yeah, go ahead.
All right, so I think a U.S. listing will come. I don't know about the order of like.
That was one of my many questions we didn't get to.
Yeah, so like they're working on so many things that could be creating tons of value for the business. So like the timeline of when each of them comes really depends on what they're prioritizing at any point. But I think a U.S. listing will come next year or the year after, hopefully next year. But if they don't do it next year, it's because something else came up, like maybe buying WeWork, that distracted them. But U.S. listing will come. I think this will get a higher multiple in the U.S. than outside of the U.S. It will be eligible for indices here, and I think that will create a lot of natural buying. And and active managers here, I think, would probably pay a higher multiple than they do in the UK.
U.S. listing is the one catalyst that I think is so crazy, because to me, like, my rational fundamental value investor brain would be like, why does something trade for more in the U.S. when it trades like plenty liquid in the UK? It's just switching venues, and every goddamn time it works. Every goddamn time.
I know why.
Well, go ahead. You tell me why.
Yeah, in the US, people contribute to their 401k or retirement accounts by buying SPY and Russell and other active or passive kind of ETFs or mutual funds that literally drip flows into US companies. If you look at UK owners, UK resident ownership of UK companies over time, it's been like this. They've used it as a piggy bank. They've literally been net sellers of UK stocks over time. In the US, people have been net savers into the stock market over time. I think that's a huge difference.
You are probably right. It's just, it blows my mind every time, because my rational fundamental brain says it shouldn't matter when you flip your venue, but it works every gosh darn time.
Yeah. And then the other thing is, I do think that the buyback is going to get turned on. So, right, the dividend got turned off and the buyback got turned off during COVID. The dividend just got turned back on this year in a very small way. But once they get to 1x net debt to EBITDA, which should happen by the end of this year, early 2025, they're going to start aggressively buying back their stock. The only way they won't aggressively buy back their stock is if it's up a lot from here, or if they have other great uses for their capital, like buying WeWork. So like, I think you do have an event path here of US listing, free cash flow growth, potential to buy WeWork, buyback coming back, while revenue and profits are inflecting. I just think there's a lot of good things going on here.
Buyback. So this was on my list of questions. Capital allocation. They initiate the dividend, and I'm talking fast because we're going to need top soon, but they initiate the dividend, and I was a little surprised by the dividend, because you own a lot of stock, you're approaching 1x leverage, the stock seems undervalued, buy back the damn stock. And I was kind of wondering, they said it's a progressive dividend. I was wondering how much this is smart capital allocation versus Mark saying, hey, I'm going to sell some shares, I need to turn this back into an income stream. Just quickly on the dividend, what were your thoughts on that?
Yeah, I think he needs an income stream. I think, like I said earlier, it used to be his income stream. It got turned off. I think he wants it turned back on. I think the buyback will come as well with the dividend. And by the way, we didn't even talk about gap conversion, which is happening this year as well. So lots of good things on the horizon.
Yaron, the shirt is going to be in the mail. Appreciate you hopping on. Do you have a hat as well? I had to wear the wrong hat because I had my hat in the baby's room, so I couldn't go get that. But you have the hat?
I do have the hat. Thank you.
Shirt and hat next time. But Yaron, this was great. We'll talk soon, buddy. And thanks for hopping on for the 4th time.
Thank you.
A quick disclaimer. Nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.